We've had it pretty easy in the financial markets over the past decade to 15 years. In that time, the S&P 500's earnings have roughly doubled while the price has tripled, and the highest federal funds rate we've seen before. What's happening right now is just 2.5%. And while that is good, the thing could still go sideways. Keep on watching to know more. Also, don't forget to hit the like and subscribe buttons. The recession was protracted and gloomy, dragging the financial markets and businesses to their knees. Central banks worldwide stepped in, printed trillions of dollars, doled it out to businesses and consumers, and kicked the can down the road. But now inflation is at 40-year highs, and the game of printing money to save us is no longer effective. Aside from that, the Federal Reserve, as we've seen, has been gradually increasing interest rates. Tightening the financial news on residents and enterprises alike has stifled spending, slowed business, and given the financial markets a headache. Digital currencies are no longer functional. The real estate market has taken a significant hit. The stock market is looking pretty wobbly, and businesses are struggling. Investors are selling off of their holdings out of fear that the deep recession we had to have is here. Yet despite all that has happened and will happen over the next year or two, this could be the best time of your life to get ahead and build your wealth. There should be a blanket ban on stock ownership because consumers are too sensitive to price changes. Of course, the basic idea of investing is to buy low and sell high. But in practice, most people do the opposite, buying high and selling low. They don't intend to do this, but fear, uncertainty, and doubt scare them out of the market when times get tough. As people like War point out, this is a mistake. The fact that most people don't have defined investment goals and don't commit to long-term investing time is the critical element that produces this reverse psychology when stocks are going up. Consequently, when terrible news and the recession arrive on the horizon, you won't seize the moment and will miss it. They avoid potential short-term suffering by running away, which is a poor decision in the long run. Look at this document that details the ups and downs of the US market from 1926. Market upswings are shown in blue, downturns in orange, and recessions as massive exclamation points. Since 1926, there have been 15 recessions and 11 bear markets, 12 if you include the 2020 dip. The bear market will have lasted for 14.7 years. Compare that to the 75.4 years during which the market was on a bull run. And you can see why these numbers are terrifying. In the aftermath of the Great Depression, investors made 265% in 4.4 years. In the aftermath of the next bear market, investors made 43% in 1.8 years. In the aftermath of the next bear market, investors made 210% in 4.1 years. In the aftermath of the next bear market, investors made 908% in 14.8 years. And the trend continues. While it's impossible to pick the market bottom ideally, and in reality, you probably won't get precisely those returns, it does show you just how big of an opportunity a bear market can be. For example, if you invested at the market's peak before the 2020 covert drop, you would have returned 20, 30, 40, 50. There were bear markets for 14.2 years and bull markets for 75.4 years. These opportunities to endure short-term discomfort in exchange for long-term gain are highly unusual. Warren Buffett gives us this question: how can I, as an investor, make the most of the opportunities presented by recession without making a catastrophic error? The first step is staying abreast of market developments to recognize when favorable opportunities present themselves. The second is appropriately implementing your chosen strategy, passive or active investing. Step 1 is to keep yourself informed, but step 2 is to execute your investment strategy and energy correctly when you see the market turmoil. As we all know, there are two main ways to approach long-term investing: dollar cost averaging and the Warren Buffett style of long-term value investing. Dollar cost averaging is brilliant because it allows investors to buy more when the price is low and fewer shares when it is high without changing their investment strategy or behavior. However, many investors prefer active portfolio management and a Warren Buffett-style approach rather than passive investing. They recognize their competitive advantages, the caliber of their management teams, and their current rates represent a significant discount. I won't cover the entire strategy in this video. It would take about 8 hours because that's the subject of the introduction to stock analysis, which you can watch on Profitable via the link in the description if you're interested. However, I wanted to touch on how active investors could protect themselves from being scammed in the current economic climate. Currently, many businesses are reducing prices because consumers are spending less on discretionary items. Still, on the other hand, businesses like Coca-Cola have such substantial competitive advantages that they can raise prices without suffering a significant drop in sales. In Q2, they increased their drink sales by 8% and concentrated sales by 4%. For example, Google has more cash on hand than that, with a debt-to-equity ratio of just 0.05. They make more interest than they pay out in interest. And best of all, they have no debt at all. As Peter Lynch would say, it's tough to go out of business if you have no debt. It's important to consider how well a business will fare in times of economic uncertainty. While grocery stores tend to do well in downturns because people can't afford to stop buying food and toilet paper, travel agencies and insurance providers may feel the pinch as consumers cut back on discretionary spending due to higher rates and lower disposable income. And with that, we have concluded this video. Please let us know in the comments what you think of the topic. Come on, let's have a chat in the comments. Please hit the notification bell and like and subscribe if you enjoyed this video. With your aid, Stockologist can expand its YouTube channel even more. Please join us for the next episode, and we appreciate your attention.